So today I'm going to do a bunch of scenario analyses regarding how a seed investor could consider an investment in a startup with high technical risk and low market risk. So I picked a startup, one that is just an awesome company, and two, I think plays on both of these extremes really well. So that company is Loyal, and Loyal is developing a safe and non-abusive drug for dogs that will extend their lives by another year or two. So it's an awesome company, first of all, but they're also building a longevity drug. I mean, there's no drugs out there, humans, dogs, anything that extends the life of a living being. So this is obviously a highly risky project from a technical standpoint. They're building something truly revolutionary and creating their own market. So what I was curious about is how would a seed investor consider investing in Loyal when being pitched when Loyal was just an idea by one single founder. So I went ahead and built several scenario analyses based on various bear and bull cases around the technical and market risk facing this project and this company. So first, I'm going to elaborate on some key inputs like the market size, and then get into the technical risk a little bit, and then talk about how those coincide to conduct a discounted present day valuation based on certain outcomes for Loyal in the future. So first, let's talk about the market. Now, in terms of the TAM, 62 million US households own an average of 1.46 dogs. So there are about 90.5 million dogs in the US, 52.4 of which are 7+ years old. So that's how we get the TAM, 90.5 million times 52.4%. Next, for the SAM, the serviceable addressable market. So in this scenario, the bear case, I said that only 10% of dog owners would use this product. Now, before I get into the SAM and SOM, again, the serviceable addressable market and the serviceable obtainable market, I want to lay out a few more stats regarding how much Americans love their dogs. So 90% of Americans say their pets are like their children. About 50% said they'd sleep outside or give up eating out for a year if their dog could live a year longer. And 41% of Gen Z would spend $100 on their pet before spending it on their partner. So Americans love their dogs. So in the bear case, again, what's the worst case scenario or the worst good case scenario, I suppose? I put the service addressable market, again, how much of that TAM do you think you can actually address? So here I'm saying that they can only address 10% of dog owners who would reasonably pay, again, $480 a year for this product. This is the bear case. I'm also saying that of those 10%, this 4.7 million, only 20% of those will buy Loyal's products because maybe a lot of competitors enter the market. Maybe someone creates a better product after Loyal and they become the second or third player in the market. So in this case, I'm saying only 10% of this total addressable market purchase a product like Loyal, a dog longevity drug, and only 20% of those customers purchase Loyal's drug. Again, which they're charging $480 a year for, $40 a month. So their TAM is 22.7 billion. Their serviceable addressable market about 2.3 billion. And then their serviceable obtainable market, the most reasonable amount they can obtain based on their TAM, SAM, SOM, based on all this data about dog owners, how much they love their dogs. Serviceable addressable market is about $455 million. Now, if we go to the base case, again, same TAM. The addressable market is different now. So here I'm saying 30% of dog owners would be willing to purchase a drug like this. Again, I also raised the price to $50 a month. The CEO of Loyal said they'd price the product somewhere between $30 to $70. So I have it in the base case of them pricing it at $50. And then I'm saying for the serviceable obtainable market, Loyal doesn't really have any major competitors that enter the race. So they can maintain 40% of that market. Maybe be a dominant player or maybe be a number two in a close battle, whatever it may be. That leaves them with targeting about 5.7 million dogs, paying $600 million a year. I mean, obviously their owners are paying, but you get my point. So that makes their TAM about 28 billion, serviceable addressable market, 8.5 billion, and the serviceable obtainable market, about 3.4 billion. So here's a big jump from the base to bear. Go into the bull, and then I'll talk about these serviceable addressable market numbers a little more. Here, same TAM, serviceable addressable market. Here we're saying 60% of dog owners would purchase a product like this. And I'm saying that Loyal is so good, they have such strong first mover advantages that they can keep 60% of this market and sell to 17 million dogs at $600 a year, making their TAM about 28.4 billion, serviceable addressable market about 17 billion, and the serviceable obtainable market about 10.2 billion. So let's get into these numbers a little bit because they're obviously insane. And let me explain to you why I'm defending these numbers if you're already hesitant. So, like I said, 90% of Americans say their pets are like their children. About 50% say they'd sleep outside if it meant their dog could live an extra year. So, I don't think it's too crazy to say that 50% of dog owners or so would pay $480 or $600 a year for their dog to live another year. Crazy. I mean, when you think about it, that's only like $2,000 over 3 or 4 years total to give your dog another year of life. I think that's a no-brainer for a lot of dog owners. At least maybe 50%. But in my bear case, I'm saying only 10% of those do that. And Loyal is going to be the first player in this market, most likely. If they can get their drug FDA approved, they're going to have that first mover advantage. So they're probably going to get more than 20% of the market. So I don't think this, even though this is a bear case and I'm saying they make $455 million, I think that's already pretty bearish. And so this goes into my point about how in these markets where they're building their own market, where the technical risk is so high, but the market risk is so low because they're creating a market, you can get these insane multi-billion dollar outcomes. I mean, even the base case, 30% of dog owners using this product and Loyal getting 40% of the market. I still think that's a little bearish than what it could be. I mean, if I had to say, I would say Loyal can probably sell to 50% of the dog owners, close to this 28 million, somewhere between these two numbers. And since they're having first mover advantage, they're going to get 100% of that market on day one. So they're going to have a strong position at the start before competitors enter the market. Now, revolutionary drugs like Wegovy and Ozempic from Novo Nordisk, they have about 55% of their market share, with Eli Lilly's Mounjaro kind of the only real competitor in that space. So I don't think 50% of dog owners buying a product like this and Loyal having 50% of the market is that unreasonable. I think if I were to say, my personal opinion, they're in between these two numbers. This might be a little bullish, but maybe their serviceable attainable market is $6 or $7 billion that they can do a year. I mean, it's crazy, obviously, but they're building a market themselves with such a revolutionary product that people will be lining up at the door for. So that's my case for their market. And this is why I've calculated their market as such. Now we're going to get into the scenarios a little bit. So first, let me explain the technical risk because that's a major factor here. The technical risk in my bear, base, and bull scenarios is 2.5% for the bear case, 5% for the base case, and 10% for the bull case. Now, I went with these numbers because it seems like 10% of venture-backed startups have a strong outcome, an IPO or a large acquisition, have a fund returning outcome. So I'm kind of putting a handicap on that, giving them a 5% chance in the base case scenario. Since this is pretty crazy. I mean, they're creating a revolutionary drug. They seem very qualified, at the time of this seed investment, but it's extremely risky. It's riskier than a general SaaS product in terms of whether it would actually work. But at the same time, the technical risk is so high that the market risk is so low that in a way it's less risky than a typical B2B SaaS product. So I think the technical risk, bearish being 2.5%, base being 5%, and bull being 10%, I think it makes sense. You could be a little more bearish. I don't think you can be too much more bullish. Maybe some investors put it at 1%. Maybe some investors put it at 20% if they understood the science a little more. I don't know. I didn't talk to any investors. But we're going to go through a little scenario analysis here to see how an investor would consider investing in a company with such high technical risk and such low market risk. So first, let's look at this case, the bear case for the market risk and the bear case for the technical risk. Again, technical risk being 2.5%. We went through the TAM already, 47 million dogs, serviceable obtainable market being, 10% of dog owners purchasing a dog longevity drug and Loyal having 20% of that market. Those customers paying $40 a month, meaning their ARR, again, that serviceable obtainable market, being about $455 million. So we already know that. Here's where it gets a little interesting. So if they were to exit with that kind of ARR, with their ownership of this market, I'm giving them a 7.5 price to sales ratio. That's what this number is. Now I'm coming off this because, again, Novo Nordisk, the company behind Ozempic and Mounjaro, they're about at a 15. because their product is so revolutionary, have such a stronghold on the market. Now, even though Loyal has such a revolutionary drug, they're not the market leader according to this scenario. They only have 20% of the market, and they don't have a huge market adoption. Only 10% of dog owners are using this product. I don't know how fast this market grows really, because there's not so many more dogs entering the market per year. It's more so just how many owners enter the market. So I gave them about half the price to sales ratio. Again, assumptions. So based on that, they would be valued at about $3.4 billion at an exit based on these scenarios. Now, if we were to invest in the seed round, the actual seed round for Loyal was $11.1 million. I don't know how much of the company the CEO sold. I'm assuming it's 20% general high end for a seed valuation because, this is a pretty risky startup. So that values the company at $55.5 million. So if you look at the risk adjusted exit valuation, which is just the projected exit valuation, again, 7.5 times sales of this serviceable obtainable market in the bear case scenario, $455 million. That number is multiplied by this 2.5% technical risk. That gets you the risk adjusted exit valuation. But what you have to also consider in a VC investment is that if you invest in one company, that means you're investing in one less company. And you need a large fund so that you can ensure at least one of your companies makes it. So I calculated that as taking this risk adjusted exit valuation and discounting it for other investments over a 10-year fund. And so how I calculated this, if you can see in this top left corner, I took the risk adjusted valuation, divided it by 1 plus 0.4, which is to represent that the target IRR for a top decile VC fund is 40%. So that's what they're potentially missing out on. That's the IRR they need to get. So that's their discount rate over a 10-year period, because that's how long these funds typically are. You can make it to 12. I'm just keeping it at 10 for simplicity. So that's how I'm discounting that. So based on these discounts, based on the market risk and the technical risk, all these outcomes, the valuation today, discounted back, would only be about $3 million. So that's much lower than this $55.5 million. So if this is what I believed about the company, about Loyal, I would not invest in this company. Now let's change some of these levers. Let's say, I still thought it was really risky technically. Let's say I still wasn't sold on the market, but I thought the technical risk wasn't as bad. Maybe it's my base case scenario, in which case that's a 5% chance. Market stays the same. All that changes here is this risk adjusted exit valuation. It's obviously twice as high. You can do that math, 2.5 to 5. But still, that discount valuation is so low. I wouldn't do this. Even if the technical risk I was pretty bullish on, I wouldn't do this. It's only about $12 million. Now, here's where it gets interesting. Let's say I'm still pretty bearish on the technical risk, only have a 2.5% chance of succeeding. But if I'm relatively confident about the market risk, now this number is getting interesting. Now we see these numbers changing, again, to our serviceable obtainable market numbers, where 30% of dog owners purchase a dog longevity drug like Loyal, and Loyal gets 40% of that market. That's about 5.7 million dogs they're selling to at a $50 a month price point, making their ARR at the exit about $3.4 billion. So here, I also changed the price to sales to 10 because, as I said, Novo Nordisk is about a 15. Maybe Loyal's the market leader in this position at 40% of the market. Maybe they're the close number 2 player. So they're getting a little higher of a price to sales ratio here, but still it's just not going to be a super fast growing market. So they can't have too high of a price to sales, but they have a near monopoly or a duopoly on this market. So that commands quite a high price to sales ratio. So I'm giving them a 10 for that. Because of that, that would value them at about $34 billion at exit. So these numbers are starting to get quite large. Same ownership percentages, same investment amount, risk adjusted valuation. Again, that projected valuation at exit multiplied by the technical risk. That gives us about 853 million. If we discount that, same thing, that 40% IRR target over a 10-year fund, we're still below that benchmark of that 55 million. So an investor still wouldn't do this if they believed in their assumptions. Obviously, these are assumptions. They don't mean everything. But based on these assumptions, an investor probably wouldn't do this deal. Let's keep going though. What if you were still super bearish on the technical risk, but you were really bullish on the market risk? You felt that if Loyal could build this product, they would be a market leader and many dog owners would purchase this product. Let's see what happens there. All right, so now we get something really interesting. Same numbers here, except the serviceable obtainable market. Again, this would be 60% of dog owners purchasing a product like Loyal, a dog longevity drug, and Loyal having 60% of that market of people who are willing to purchase a dog longevity drug. So this is the Novo Nordisk scenario. This is when they have, 60% of the market. A lot of people want this drug. Again, 50% would sleep outside to let their dog live a year longer, apparently. So this isn't too crazy. Even though it's my bull case, not too crazy. I think it's more bullish to think Loyal can have 60% of the market, assuming competitors enter the race. But they have that extreme first mover advantage. So it's possible. So in this bullish scenario, they're selling to $17 million at a $50 a month price point, giving them a 10 million AR, giving them a 10 billion ARR at exit. Price of sales have bumped up to 12.5 because they are the market leader in a near monopoly setting with predictable revenue over a multi-year timeline. So I'm giving them a 12.5 price to sales ratio, still slightly lower than Novo Nordisk's 15 because their market's not as large, but still really predictable revenue over a multi-year time scale. This would be a great company to invest in. It'd be safe. So that would give them an exit valuation of $128 billion. Crazy, I know, but possible. And so here's the first time where we'd actually invest. Same investment amount and percentage, except now you see that discounted valuation is higher than this 55 million, about twice as high actually. So that would give us enough wiggle room to say, yeah, we would invest. So let's keep going. All right, so now let's bump this market risk back to a 2, our base case. Let's make this technical risk our base case. Here we have an interesting scenario. Again, same numbers as the prior base case, that 3.4 million ARR, that 5.7 serviceable obtainable market, 10 price to sales. Now we have a situation where we're actually barely above that post-money valuation when we look at it from a discounted valuation perspective. So if you're married to these numbers, you'd say yes and invest. If you were a little hesitant, maybe not. Regardless, you can see how much the market risk has a weigh on these things. If the technical risk stays at 2, if it's still only a 5% chance. But if we're really bullish about the market, again, 60% of dog owners with Loyal having 60% of that market, discount valuation is huge. You would absolutely do this investment. It'd be a no-brainer. If we go back to a base case, if we change the technical risk to a 3, 10% chance of this succeeding with the base case of the market, again, you do this deal. If you were the biggest bull of all bulls, you would stupidly do this deal. It'd be an absolute no-brainer. So that's how a VC might think about this when doing a seed investment. They calculate their own market risks based on what they think, what research they've done, what research the founders have given them. And then they'd go back and say, all right, what's the chances we think this product can actually be built? Is it a 1% chance? Is it a 2.5% chance? Is it a 20% chance? I mean, let's even look at a 1% chance. That's interesting. You wouldn't do it anymore. Even if you think the market's going to be insane, if it's just a 1% chance of succeeding, you wouldn't do this investment. So I suspect any investors that passed thought this company had less than a 2.5% chance of success. Maybe they thought there was only a 1% chance, and so they didn't do it. Maybe some investors thought there was a 20% chance, so it was a no-brainer for them. Point is, everyone has their own numbers for the market risk and technical risk of a product, and every investor can use this scenario analysis to calculate, okay, how many scenarios out of the ones I'm predicting, if they're right, do I invest? And so if you were following along, 5 out of 9 of these scenarios were in the green, where the discount valuation was greater than the post-money valuation at the seed round. So you do that investment, but also, even if it was like a 3 out of 9, you'd still maybe do the investment because the bull case scenarios, again, are so huge. Like that valuation is so much higher than the post-money valuation. And that exit valuation, if you own 20% at the seed stage, I mean, if you take that, multiply it by 5%, which you maybe own at the end of the day when the company IPOs, $6.4 billion. So like the outcomes are so potentially massive that you would have to do a deal like this if you think there's somewhat of a chance for them to have such a crazy outcome from a market standpoint if they can succeed in this product. Again, if you think there's a 2.5% chance, that market risk is so crazy, that $6.4 billion return is so crazy, you'd have to try to make this investment. So this is just a little fun spreadsheet analysis you can do. if you're a seed investor, to look at, why you would invest in a company, if you would, depending on what you predict about the technical risk and what you know about the market risk. I would be really interested to speak to any investor who considered investing in Loyal to see what their numbers for the technical risk was. I think my market numbers are pretty reasonable. Again, that's just from data online. I think all that makes sense. So I'm not too worried about those. I think these are good. My question is that technical risk something like a 1%? And then it gets pretty interesting whether you do it or not. Is it something like a 0.5% and you're like, there's no way, this is too risky, I don't see that outcome happening? Who knows? All I know is that these companies where there's a low market risk and a high technical risk have insane potential outcomes. And this is a nice, fun way to calculate those outcomes and see what happens. So, hope you thought this video was interesting. I think it was kind of fun to actually play around with this stuff. Let me know in the comments if you want the sheet. I can send it to you. And if you enjoyed this post, please give it a like. If you want to see more posts like it, subscribe for future content. And I appreciate you listening. Take care.